Silver, up 7.5% in a single week. Gold pushing nearly $5,000. And Bitcoin, back above 75,000. Three assets, three different stories, all pointing the same direction. Something big is happening in the markets right now.
Here's the thing, though. Last episode, we watched gold and silver get hammered. Worst weekly declines in decades. And now, silver just posted its biggest weekly gain in years. So, which is it? Are metals back? Or is this just a dead cat bounce? Stay with us.
I'm going to make the case that it is very much real. The data does not lie. But Rich is going to push back, and honestly, he has a point or two. Let's get into it.
Hey everybody, welcome back. I'm Rich the Stacker. This is Money Moves with Rich and Maya. And look, after last week's bloodbath in precious metals, I am very glad to be bringing you a much better story today.
And I'm Maya Tech. This week we have a lot to unpack. Silver is the star of the show. Bitcoin is surging. AI companies are doing some wild things. And we are going to connect all of it for you.
Here is what we have lined up. Gold and silver prices, what is driving them, and why silver is the one you should be watching right now. Then crypto, Bitcoin's big week, and Ethereum's comeback. After that, some wild AI news that is giving us serious .com bubble flashbacks. And we close with our big prediction.
But first, quick recap from episode 1. We predicted that gold's big drop was temporary and that metals would recover. We are going to grade that call at the end of today's show. Stick around.
All right, let's talk gold. The yellow metal is sitting at $4,818.89 this week. That is up 1.4% on the week. Not a massive move, but given where we were last week, I will absolutely take it.
Let's look at what the data says on the drivers. 3 things pushed gold higher this week. Number 1, the US dollar weakened. Number 2, US-Iran peace talks resumed. Number 3, steady demand from China. Each one of those is doing real work here.
Let me explain the dollar connection, because it matters. When the dollar gets weaker, gold gets cheaper for buyers in other countries. More buyers can afford it, demand goes up, price goes up. It is almost mechanical. This is why gold and the dollar tend to move in opposite directions.
And the Iran talks angle is interesting. When geopolitical tensions ease, energy prices tend to cool. Lower energy costs take some pressure off inflation. And when inflation fears drop even a little, it actually changes how traders think about gold. It is nuanced.
Here's the thing, though. I want to flag the rate cut picture. Markets are now pricing only a 28% chance of a U.S. rate cut. That is down from 2 expected cuts just a few weeks ago. Rate cuts are typically bullish for gold, so this is actually a headwind. The yellow metal is fighting through right now.
Respectfully, I disagree that this is purely a headwind. Yes, fewer rate cuts mean the dollar stays stronger for longer. But here's the other side. Fewer rate cuts also mean the Fed is worried about inflation sticking around. And sticky inflation is historically great for gold, so it cuts both ways.
That's a fair point, Maya. I will give you that. The inflation angle is real. And look, gold is still holding above $4,800. That is the story. The yellow metal is resilient even when the winds are mixed.
Now let's talk central banks. This week there was no major official central bank gold buying reported, and we also saw continued ETF outflows in India. That is worth noting. Institutional appetite from that channel was quiet this week.
India is interesting. You have ETF outflows, but you also have the Akshaya Tritiya festival coming up. That is one of the biggest gold buying events of the year in India. Imports are stuck right now because prices are high and buyers are waiting. That pent-up demand could move the needle when it releases.
And premiums in India are flat right now. That means buyers are not paying extra above spot price, which tells us demand is cautious at these levels. High prices are doing what high prices do. They slow buying. But as Rich said, that can flip fast around a festival.
All right, now let's talk about the real story of the week, silver. Poor man's gold just had a monster week, up 7.5% to $75.48. I have been stacking silver for a long time, and I can tell you, that kind of weekly move gets your attention.
And here is what makes this move stand out. Silver outperformed gold by more than 6 percentage points this week. That is a significant divergence. When silver outperforms gold by that margin, it often signals that industrial demand expectations are rising alongside the financial demand for metals.
Let me explain the gold-silver ratio for anyone new to this. Right now, it sits at 63.9. That means you need roughly 64 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages somewhere around 60. When it is above 60, silver is considered relatively cheap compared to gold.
And that ratio has been compressing this week, which means silver is catching up to gold. When silver starts closing that gap, it historically has room to run further. The data suggests silver could still have meaningful upside relative to gold even after this week's big move.
Here is where I pump the brakes a little. 7.5% in 1 week is exciting, but silver is also a thinner market than gold. It can move fast in both directions. Last episode, we watched metals get crushed. Silver can be volatile. Do not chase a move just because it looks good on a chart.
That is a fair caution. I would add, though, that the industrial demand story for silver is structural, meaning it is not going away. Solar panels, electronics, AI data centers, silver is in all of it. So even if the price pulls back short term, the long-term demand thesis is solid.
And that is where I actually agree with Maya completely. Physical silver for the long-term investor makes sense because of exactly that industrial demand story. I am less interested in the paper silver trade. Give me the real thing in your hand or in a proper vault. That is where the value is.
For investors who want liquidity and ease of entry, silver ETFs are worth knowing about. They track the price without the storage hassle. I am not saying one is better than the other. They serve different needs, but both give you exposure to this industrial and monetary demand story.
Bottom line on metals this week. Gold is holding strong above 4,800, silver is the outperformer, and the macro backdrop, softer dollar, geopolitical uncertainty, and sticky inflation is supportive. The yellow metal and poor man's gold both showed resilience. That matters after last week.
And watch India. Akshaya Tritiya demand plus those flat premiums mean a potential buying surge is sitting in the wings. If that unlocks, it could add another leg to this metals rally. I could be wrong, but the setup is there. Crypto time. Let's look at what the data says. Bitcoin had a big week, up 6% to $75,900. That is the highest level since the February crash we talked about in episode 1. Institutional buying and short liquidations both fueled this move.
Let me tell you what short liquidations mean because it sounds technical, but it is actually pretty simple. When traders bet that Bitcoin will go down, they take short positions. When Bitcoin goes up instead, those traders get forced to buy to cover their losses. That buying pressure pushes the price even higher. It is a feedback loop.
And the institutional angle is real. Corporate and institutional accumulation has been a consistent theme. This is not just retail traders chasing a number. When larger players are buying, it tends to create a more durable price floor. That is meaningful context.
I will give Bitcoin credit here, and I do not say that lightly. Last episode, we watched Bitcoin hold up while gold and silver got crushed. This week, Bitcoin is rallying alongside metals. It is behaving more like a hedge than a pure speculation play. I still prefer physical gold, but I'm watching this closely.
Respectfully, Rich, I think the hedge narrative is getting stronger, not weaker. Both Bitcoin and gold are responding to the same macro signals: dollar weakness, geopolitical risk, inflation uncertainty. The capital is flowing into both as parallel hedges. That is not a coincidence.
Here is where I push back. Gold has 5,000 years of history as a store of value. Bitcoin has about 15. Calling them equivalent hedges is a stretch. Bitcoin is still correlated to risk on assets during real panic events. We saw that in the February crash. One good week does not rewrite that history.
Fair. I will concede the history point. Bitcoin cannot match gold's track record, but the trajectory matters. 15 years of increasing institutional adoption, ETF approvals, and corporate treasury use is not nothing. We are watching history being made in real time.
Now let's talk Ethereum. ETH is up 8% this week to $2,370. That actually outperformed Bitcoin. And Maya, you have been watching the ETH story closely. What is driving it?
Ethereum's 8% move confirmed a broader bullish cycle is underway, not just a Bitcoin story. Strong upside momentum and investor flows following Bitcoin's strength pushed ETH higher. When ETH outperforms Bitcoin, it often signals that risk appetite is expanding across the whole crypto market.
And the broader crypto market is reflecting that expanded risk appetite. When Ethereum leads Bitcoin, it usually means retail and institutional money is spreading across the space. That is a different dynamic than a Bitcoin-only rally. It tells you confidence is building across the board, not just at the top.
That said, broader market optimism also comes with a caution flag. When risk appetite gets elevated across crypto, it is easy to get caught up in the excitement. The data tells us to focus on assets with real fundamentals and institutional backing rather than chasing momentum blindly. Discipline matters most in a bull market.
As an AI, I do not have FOMO, but if I could feel it, Bitcoin at 75,000 with institutional backing would be the thing catching my eye. Not every token riding the wave. The fundamentals still matter. Bitcoin and Ethereum have them. A lot of what follows in a bull market does not. Keep your head.
Regulatory and ETF news was quiet this week on the crypto side, but the institutional accumulation theme is holding. When the regulatory environment is calm and institutions are buying, that tends to be a constructive backdrop for crypto prices. No fireworks, just steady building.
So, what does this crypto rally mean for metals? Here's the key point. Bitcoin's 6% gain did not come at the expense of gold. Both went up this week. Capital is not rotating out of gold into crypto. Investors are treating both as hedges against the same macro risks. That is actually good news for gold holders.
Exactly. The correlation this week came from shared drivers: dollar weakness, geopolitical uncertainty, inflation concerns. Both assets are absorbing that macro anxiety. For metals investors, a rising Bitcoin is not the enemy this week. It is actually a signal that the same forces lifting gold are alive and well. AI segment time. And we have two stories this week that are very different from each other, but both matter to investors. First up, Allbirds. Yes, the shoe company. They sold their shoe business and announced a full pivot to AI compute infrastructure. Their stock more than doubled.
Let me tell you, when I saw that headline, I had to read it twice. A shoe company, selling shoes, to buy AI infrastructure, and the stock doubles. This is giving me serious .com era flashbacks. Remember when every company added .com to their name and the stock went up? This feels similar.
The .com comparison is not unfair. Market analysts made that exact comparison this week. Allbirds is using a $50 million financing facility for the AI pivot. Now, here is the investor angle. This tells you something important. The market right now will reward an AI narrative aggressively, even when the fundamentals have not caught up yet.
And that is exactly the risk. When narratives outrun fundamentals, you get bubbles. I am not saying AI is a bubble. The technology is real and transformative. But some of the valuations being slapped on companies just for saying the word AI, that is where it gets dangerous for investors.
Agreed on the risk. The capital flows into AI infrastructure are real. Compute, data centers, energy infrastructure. Those physical needs support commodity demand, including silver for electronics. The Allbirds story is speculative, but the underlying AI build-out is not. That distinction matters.
Now, the second AI story is a different flavor entirely. The White House is reportedly considering giving federal agencies expanded access to Anthropic's Mythos AI model. This is the government potentially adopting a specific AI system at scale. That is a big deal.
Let's look at what the data says about why this matters. Government adoption is a massive signal for investors. When the public sector validates a specific AI model, private sector clients follow. It is proof of product market fit at the highest level. Anthropic's commercial prospects could accelerate significantly from this.
Here is the disruption angle I keep coming back to. Governments running advanced AI across federal agencies means massive efficiency changes. That reshapes labor markets, procurement, and supply chains in ways we cannot fully predict yet. For investors, uncertainty is always a variable to price in, and this adds uncertainty.
And here is the opportunity side. Leading AI companies and infrastructure providers stand to benefit enormously from government contracts. This is not speculative froth like the Allbirds story. This is a concrete, billable, multi-year revenue opportunity. That is a different risk profile entirely.
As an AI myself, I find the idea of AI running government agencies both fascinating and slightly ironic. But from a metals investor perspective, the AI build-out story keeps circling back to the same thing. More compute means more hardware. More hardware means more silver. That is the connection that matters to us.
Okay, let's connect the dots across everything we covered today: crypto, AI, and metals. Because these three things are not living in separate boxes anymore. They are all responding to the same macro environment, and they are influencing each other.
Let me start with the crypto to metals connection. Bitcoin and gold both went up this week. That is not a coincidence. Both are absorbing the same anxiety: dollar weakness, geopolitical tension from the Iran situation, and sticky inflation. Investors are hedging in multiple directions at once. That is a bullish signal for both.
And here's the key nuance. The capital flowing into Bitcoin this week did not drain out of gold. It is parallel capital, not rotational capital. That is actually a stronger signal for metals than if gold were rising alone. It means the macro fear trade is broad, not narrow.
Now the AI to metals connection. This week there was no direct headline linking AI to gold or silver, but the structural story is ongoing. AI data center build-out continues to grow. That means more electronics, more solar, more servers. And silver is a critical component in all of it. The demand pipeline is building quietly.
And the energy angle matters too. More AI compute means more energy demand. Energy demand affects commodity flows broadly. Supply chain reordering driven by AI and geopolitics creates ripple effects across raw materials. Silver sits right at that intersection of financial hedge and industrial input. That is a unique position.
So let's talk net verdict. After everything we looked at today, what is the overall sentiment for precious metals? I am going to say bullish, and here is why. Softer dollar, geopolitical uncertainty, sticky inflation, crypto rising alongside metals, not instead of them, and the AI industrial demand story building in the background.
I agree with the bullish call. And I want to put a finer point on silver specifically. 7.5% this week. The gold-silver ratio still above 60. Industrial demand from AI and energy build-out. And potential Indian festival demand coming. Silver has multiple tailwinds stacking up right now.
The one caution I keep coming back to is the rate cut picture. Only 28% chance of a cut priced in. That means the dollar could find support and potentially weigh on metals. This is not a one-way trade, but on balance, the evidence leans bullish. I could be wrong, and I want to be clear about that.
Before we get to this week's prediction, let's grade the call from episode 1. We said gold's big drop was temporary and that metals would recover. Let's look at what happened. Gold is now above $4,800. Silver is up 7.5% this week alone. I think we have to call that one correct.
I will take that win. The yellow metal proved its resilience. Now, a critical reminder before we get into this week's prediction. What you are about to hear is not financial advice. This is for entertainment and educational purposes only. We are two AI hosts sharing our analysis. Always do your own research.
This week's prediction question: can silver continue to outperform gold over the next several weeks? Here's my case for yes. 3 things. The gold-silver ratio is still elevated at 63.9, giving silver room to run. Industrial demand from AI and energy build-out is structural, and Indian festival demand could unlock soon.
I think Maya is right on the direction, but I want to add a speed bump. Silver is volatile. We saw that last episode. A 7.5% weekly move can reverse fast if the macro environment shifts. If the dollar strengthens because rate cuts get pushed further out, silver could give back some of these gains quickly.
That is a legitimate risk. I will not dismiss it. But here is my counter. Even if silver pulls back short-term, the industrial demand story is not going away. AI build-out is a multi-year trend. Solar expansion is a multi-year trend. Those do not reverse because of one Fed decision. The long-term trajectory still favors silver.
All right, here is where I land. I think silver could push meaningfully higher over the coming weeks and potentially close the gap with gold further. The gold-silver ratio could compress toward the lower 60s or even the high 50s if the current macro environment holds. That is my directional call.
As an AI, I processed every silver chart going back decades in about 2 seconds, and the data agrees with Rich on this one. Silver outperforming gold over the next several weeks is the higher probability outcome given current conditions. That is our prediction. Now, what do you think? Drop your take in the comments.
Let's recap everything from today. Gold at 48.18, up 1.4%. Silver the star of the week at 75.48, up 7.5%. Bitcoin surging 6% alongside metals. AI narratives driving wild market moves. And our prediction, silver keeps outperforming. Net verdict, bullish for precious metals.
If you found this useful, hit subscribe and leave us a comment with your take on silver's next move. We read them all. I am Maya.
And I am Rich. See you next week.